Joining us now, Oksana Aronov, alternative fixed income strategist at JP Morgan Asset Management, and our guest host, Jason Trennert, chairman of Strategas Research Partners, is also with us. You read the notes, Oksana's notes, Sorkin?
I did. Not all of them, but I think I mean, I'll admit it. I read the first couple of pages.
Yeah,
but they're scary.
Yeah, well, she's just really.
Were there just too many, or was
no
it
trying
something?
to understand everything because you're in a very niche. You're part of the the markets is just very technical and fairly complex. And I hope I have it right. I may be a little bit nervous, and that is that fixed income is so rich right now. It depends on liquidity. And you think that that's somewhat tenuous, which scares me. And I'm wondering whether you're alluding to what happened in the last couple of weeks with the repo market, or whether there's more to that than we're giving it. Is that some type of red flag?
Certainly, that is a red flag. But kind of taking a step and broadly looking at fixed income has become a commoditized asset class. And what I mean by that is, Warren Buffett's quote comes to mind, which is that commodities depend on what someone else will be willing to pay for them 6 months from now. The commodity itself is not going to do anything for you. And fixed income in much of the world, and certainly here in the U.S., is starting to approach that. In much of the world, it's already there, meaning there's no coupon, and your return experience will depend entirely on where you buy it. And you're buying it at above par. You're not earning anything. And in Europe, you're actually losing on the coupon. And so it has essentially turned into a fixed loss investment proposition that's riding on this kind of greater fool's theory that I'll be able to flip it back to the ECB or some other greater fool buyer later on. But the problem is that you have a market that is riding on tenuous liquidity at best, meaning, just to give you an idea, 20% of all the negative yielding debt in the world is owned by mutual funds and ETFs. This is not a cohort of investors that likes to sit on losses for long periods of time. They will be looking to get out pretty quickly if we have any kind of turn to the current kind of central bank supported environment. And again, to give you an idea, the top 5 corporate bond ETFs currently have double the inventory of all the corporates held on the street.
There's about $15 trillion, I believe, in negative yielding sovereign debt.
Down from 17.
Down from 17. But it's doubled, I think, over the last year. How much can let's say trade were resolved as an issue tomorrow, and expectations for global growth were to bottom and to pick up. How much could the U.S. yields really diverge from the rest of the world? Meaning, do you have a target for the let's say the 10-year Treasury yield? Is it possible for it to go back up towards the old highs, which would be well between 2% and 3%, or is that?
This is what we consider high, between 2 and 3%. Right. Yes. I mean, look, it's certainly not impossible, because if you look at the period between 1970 and 2007, for example, GDP plus inflation accounted for 97% of the 10-year Treasury level. Today, if you put those two together, you get about 40 to 50% at best. So obviously, the clouding effects of central banks have been really dramatic. And if you were to have a resolution of some of these, bricks in the wall of worry, certainly we can see rates move up. And we're also, I think, and that's where the repo situation comes into play, we're, I think, seeing the limits of central bank power to continue delivering this rally, because even if you look back before the repo situation a couple of weeks ago, when the ECB delivered really the kitchen sink, meaning lowered the deposit rate, increased their asset purchase by $20 billion, you saw European rates actually move up in the aftermath of that, right? German bonds went from like minus 80 basis points to minus 50 at some point. They're kind of back down again now. But you're seeing the limits of central bank power. And I think this means investors have to really redefine what safe havens mean in this part of the cycle, in this market. And safe havens right now, at least in the U.S., mean cash is not trash. When the curve looks the way it does, when you have this inversion or at least a flatness, you are paid at the very front end of the curve. You have no incentive to extend out. You're not paid enough to take the risk in lower rated parts of the market, with double Bs in the 200s, with triple Bs hanging over them at 3 times the size of that double B market. If we start to see any kind of downgrades, that's a lot of issuance to contend with. So there are a lot of technical pressures that are potentially building that can create recessionary pricing without an actual recession.
Oksana, just to end on something, what is your gut telling you about whether there's something looming for us? And I don't mean some wonderful thing. I mean something that something looming ahead of us, some type of day of reckoning. Is that Can we handle this? Can we unwind it in a way that it doesn't cause a lot of dislocation?
Look, we're not generally in the business of predicting kind of where the 10-year is going to be by year end, and markets have gotten this wrong consistently over time. So that's really not part of our process. We try to go elsewhere in the market and extract returns that are not so beholden.
But does anything end badly?
But
negative
when
rate?
you think about where we are in the bond markets, yes, we are in a bond bubble, no question about it. The question is, how long does it last and how does it unwind? We don't really see how it can unwind painlessly because the market is very rich, it is very highly correlated, and it is riding on a very tenuous liquidity cushion. So in this part of the cycle, the consumer still looks okay. That's something we're watching very closely because a lot of the strength of the U.S. economy continues to ride on that. So in terms of actual kind of positioning in portfolios, we think that's a good place to align yourself with an ample allocation to kind of that liquidity cushion. And also answer the question of best ideas in fixed income, not just from a long-only standpoint, but also from a short standpoint. In a world with $15 trillion negative yielding debt, that's that's a necessary way to look at things.
I would say the most shocking thing I've heard from Oksana here is who's holding the negative yielding debt, because I would not have guessed that it's mutual funds and ETFs.
The ownership of this market has changed dramatically in the post-crisis era, and that's something that has to be realized. The liquidity providers are now the buy side, but the buy side is not necessarily well equipped to be that liquidity provider. Their decision-making processes take a lot longer, et cetera. And so that's why, this is really no time to be a hero, given that you're not compensated for rate or credit risk here, and really keep some powder dry because we'll have plenty of volatility episodes in the coming
years. I think you should get her card.
Yeah.
I'm not kidding. I mean, don't you think you should call her occasionally?
I think I should. I think I got to find out
Would you manage money?